The Commercial Real Estate Show is brought to you by CohnReznick, forward-thinking advice to navigate business and financial issues. Visit CohnReznick.com. By BB&T, banking, business, and commercial real estate loans. Visit BB&T.com. And Bull Realty. When your business requires proven performance, visit BullRealty.com. And by France Media, providing exposure to the world of commercial real estate. Visit FranceMediaInc.com. Welcome to the Commercial Real Estate Show. Thank you for joining us to lead, learn, and laugh. Learn market knowledge and best practices to lead your company's success. And that's whatever type of company you work with. And laugh, I think we have to have some fun along the way. Well, hello, I'm Michael Bull, your host to the world of commercial real estate. Well, today we're going to explore the tax changes of 2013 and how they may affect jobs, business, investment, and commercial real estate. You know, there have been significant changes in the tax code, including an increase in capital gains, an increase in tax rates, and the new 3.8% Obama investment tax, which was passed in 2010 in the Health Care Act, and that has also kicked in 2013. So we'll look at what has changed, what's remained intact, and how to navigate and prosper in the world of increased tax burdens. Well, please welcome my first guest, Thomas Nice, partner with CohnReznick. The members of CohnReznick's commercial real estate industry practice work as trusted business advisors to private equity funds, pension funds, REITs, commercial and residential property owners, and operators of hotels and resorts, real estate developers, home builders, and land developers. Tom, welcome to the Commercial Real Estate Show.
Well, thanks, Michael, for having me on today.
Well, we appreciate having you on the show. And first, I'd like to ask you about the 3.8% Medicare investment tax that Obama brought on to us in 2010 that now we have to deal with in 2013. How does that work? Who has to pay it?
Well, if you have a joint taxpayer with taxable income over $250,000 or a single taxpayer with taxable income over $200,000, you're going to be assessed a tax equal to 3.8% of the lesser of your net investment income or the excess of your modified adjusted gross income over that threshold amount I just mentioned, $250,000 for joint filers, $200,000 for single filers. And essentially what that means is that if you have $1 of net investment income and your modified adjusted gross income is over that threshold amount, it's going to get an additional 3.8% tax. In addition to that, they define what net investment income is, and for most people, you would think that your interest and dividends and portfolio income, capital gains, that kind of stuff is what's subject to it, and it is. But the other thing that is of importance for commercial real estate owners is that income from any passive activity is also going to be subject to this 3.8% tax.
Okay, so when you sell an investment property, if you make over those income levels, you've got to add a 3.8% tax to that.
Exactly. So it's critical for owners of real estate to determine whether or not the income from their rental real estate is passive income or whether it is active income under the general rules of Code Section 469, passive activity rules. If you're a real estate professional, you probably your accountants have probably been talking to you about it all along.
Okay, and that's your profits over your base, right?
Basically, yes. Well, when you say profits over your base, it's your net rental income, and how you define that can be a little bit different depending on how you hold your real estate. If you have a trader business and you are renting real estate to your trader business, in the past, that income from the rental real estate would be passive income, and you didn't care because you would have income or loss from your trader business to either add to it or offset it. But now with the advent of this 3.8% tax on passive income, you're not going to want to have that property being self-rented to your trader business. You're going to want to combine that. And the good news is that in the proposed regulations, they do allow for taxpayers to regroup their activities in a more advantageous way, and that would help people avoid that passive income tax when they are renting to their own trades or businesses.
Okay. And I guess in some cases, if you're selling a property, for example, in a second quarter, and you don't know where your income levels and things are going to be, you really don't know what the tax burden is going to be of that sale, right? You've got to make some guesses.
Exactly. The problem with the proposed regulations is that even though it did a very, very good job in explaining what the government wanted to do, it still didn't explain everything. And the final regulations will be issued before the end of 2013. But in the meantime, you still have estimated taxes to pay. And if you don't really know exactly whether or not your particular situation is going to be affected by this 3.8% tax, we're recommending to our clients to file safe estimates for the quarters until we get that final guidance to avoid any application of penalties.
Right. I think it's a surprise to some people with that 3.8% tax, what the increased burden there is. I mean, Nancy Pelosi said, look, let's pass the Health Care Act so we can see what's in it, right?
Right, exactly. Another thing I want to mention about these rules regarding passive activities, the general rules of Code Section 469 govern whether something is a passive activity or not. But under these 1411 Medicare investment tax rules, you have to be an active trade or business under Code Section 162, not 469, for purposes of avoiding the application of the investment tax to that rental income. And again, the government hasn't specifically come out with any particular guidelines, and in fact, in informal guidance, they've said they don't want to issue bright line tests because they want to be able to interpret what people are doing, and they don't want to create a bright line test that people can do a workaround. So they're leaving it vague on purpose.
Nice. Okay. Well, commercial real estate is also affected by businesses, by companies hiring. What are some of the changes this year for employers?
Well, under the Obamacare package, one of the big changes is for large employers, and those are employers that have an average of at least 50 full-time employees, to provide minimum essential health care coverage. And if those businesses do not provide that minimum essential health care coverage, they're going to be assessed a penalty of about $2,000 per employee per tax year. And for commercial real estate owners, a lot of times you have certain employees that might be accounted for in separate entities. And a heads up for you is that there are special rules that will aggregate a lot of different entities into one employer for purposes of this test. So if you have a lot of different businesses, but for employment tax purposes, you're treated as a single employer, that's the test that's going to be applied here. So the fact that you have 25 people working in your construction company and 20 people working in your development company and then 15 people working in your rental real estate activities, it could be that collectively you're considered a large employer and you'd be subject to this tax if you're not providing that minimum essential coverage.
Right. That's a good point. That may catch some people off guard. And Tom, let's talk about capital gains. We've got an increase in capital gains beginning this year as well, right?
Right. Good news is that if they have thresholds of $400,000 for single taxpayers and $450,000 for joint filers, and if your income is below that, then you will be still subject to the old 15% rate. It did not go up for you. But if you're over that threshold, what will happen is that the long-term capital gain rate is going to increase to 20%. And you have to be a little bit careful because when you have this capital gains, remember, we just talked about a 3.8% investment tax. Now you have the 20% tax here that's lumping on top of it for long-term capital gains. That's 23.8% compared to 15% before. That's about a 57% increase in the capital gains rate from last year. Now, if it turns out that you don't qualify for long-term capital gains because you had a tremendous opportunity and you flipped a piece of real estate, you might be subject to ordinary income rates. Short-term capital gain rates are essentially ordinary income rates. And with the new ordinary income rates having gone up maximum rate from 35 to 39.6, if you tack that 3.8% investment tax on top of that, and you have a phase out of your itemized deductions, which is now back after a couple of year hiatus, you could be paying capital gains. If it's short-term capital gains, the maximum rate could be as high as 44.6%. which is really an eye opener for people.
Right. You got to also think about that depreciation recapture, right?
Absolutely. Depreciation recapture remains at 25%. So that means that with that investment tax piggyback, you're up to 28.8% on long-term capital gains if the unrecaptured 1250 gain rules apply to your particular gain.
Right. Okay. Well, we're going to have to take a quick break. In a moment, we'll get more from Tom Nice with CohnReznick on the latest tax laws affecting the commercial real estate industry. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is made available by professionals at CohnReznick, BB&T, France Media, and Bull Realty. For more information about these companies or to access additional show podcasts or videos, visit commercialrealestateshow.com. Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. If you'd like to know the absolute latest on any commercial real estate related subjects, check out our on-demand show podcast. For example, we had recent shows featuring leading commercial real estate trainers providing tips for 2013. We had a show on strategies for banks and lenders related to non-performing notes and OREO. And we had a show featuring forecasts on the office and one on retail, industrial, and multifamily sectors. So you can access these shows anytime on your smartphone or your computer. Visit iTunes or the show website, commercialrealestateshow.com. Well, today we're exploring the tax changes of 2013 and how they may affect commercial real estate. My guest is Tom Nice. He's a partner with CohnReznick. And Tom, I'd like to ask you about the increase in tax rates. I guess the so-called rich are going to have to pay more, right?
Absolutely. The maximum tax rate has been increased from 35 to 39.6%, but because of these other phase outs of itemized deductions, phase out of other exemption amounts, and then this 3.8% Medicare tax. Really, you could have your tax rate going up as high as 44.6%, and that doesn't include your payroll taxes. So really, when you include payroll taxes, if this is earned income, you're really seeing your federal tax jump to over 50%.
Wow, that's incredible. Well, what do you think the impact will be from these increases in these taxes?
Well, it's hard to say. I mean, with these, whenever you have increases in taxes, you always have a little bit of a decrease in activity, and to the extent that people don't have as much money for reinvestment, there's just less money to spread around. So, regardless of your politics, I think that's pretty much the fact of the matter.
Yeah, when you think about it, with these small businesses are the biggest job creators in the economy, and you've got a lot of S corp owners who are going to have some increase in their taxes. And do you really want your employer to be making less than $450? You probably don't.
Right. Well, and again, there's talk in the industry about the use of S corporations as a way to combine rental income even with your trade or business income. And for instance, property management companies, their income would not be subject to the net investment tax, and as long as you would actively participate in your property management company and your S corporation pays out a reasonable salary to the officers, any additional distributions would not be subject to self-employment tax or to the investment tax. So that could be a 3.8% savings if your businesses are structured properly. Oh,
that's good news. Well, speaking of good news, we still have the extension of the leasehold depreciation to 15 years rather than 39 years for tenant build-outs and things like that, right?
Absolutely. You still have 15-year life for qualified leasehold improvements, qualified retail improvements, and qualified restaurant property through 2013. After that, it's going to go back to 39 years. So if you have stuff that you're planning to place in service towards the end of the year, you might really want to push hard to get it placed in service, because if it's placed in service in 2014, it's going to be a 39-year life, not 15-year life.
Okay. And the commercial real estate world was also concerned about carried interest, and that was saved so far, right?
Yes, up to this point it's been proposed. If you see it's Code Section 711, they keep proposing and it keeps dying in the Senate. And the senators have not been happy with it, and they've been keeping it from going forward, even though it's been pushed by the House. Basically, what that carried interest rule is that anybody that has a promote from real estate that normally you would get upon the sale of that real estate on the back end, instead of getting capital gains rates, you would get ordinary income rates because the government treats that carried interest as some type of earned income. So again, the furor was with hedge fund managers, but they realized that they couldn't raise enough money if they penalized just the hedge fund managers, and so they started looking for additional sources of revenue, and real estate got into their crosshairs. So up to now, it has not moved forward, but with the sequester looming as of March 1st, who knows what Congress is going to do in terms of figuring out sources of revenue to avoid that sequester cut in spending. And if they need revenue raisers, this could be something that could come back. We just have to wait and see.
Yeah, stay tuned, right?
Right, absolutely.
Well, we're speaking with Tom Nice with CohnReznick. And Tom, I'd like to ask you to briefly explain the possible lease accounting change from FASB and where that stands right now.
Well, real quick, the biggest takeaway I would tell you is to stay tuned. The first exposure draft has gone out to industry, and people have commented on it, and people were pretty upset about it because the rules regarding accounting for leases, essentially they wanted to account for all leases as capital leases, and they have this method called the interest and amortization method where you would discount the present value of the lease, and then you would have an interest charge associated with it. And two things happen with that. One is it depresses earnings, and two is that it might devalue the property somewhat. So people didn't like it very much. So now they went back to the drawing board a little bit. They're working on a second exposure draft right now. This new exposure draft is going to be effective for starting in 2016. And it includes that same interest and amortization method of the first draft, but it also includes a straight line method for leases that they call it not for a term that is a major portion of the asset's economic life. So in other words, if you got a 15-year asset and you're leasing it out for 5 years, that's probably going to qualify for a straight line method, which is a simplified method. And from a lessor standpoint, the simplified method means that the asset stays on your books and you recognize income as you receive it. And on the lessee side, you create this asset called a right of use asset, and then essentially that asset's going to amortize over time, and then you're going to have some of this interest expense that you still have to book, and the difference between the two will be essentially how much your asset amortizes over the life of the lease. Again, we don't know exactly what the second draft's going to say, but we know it's going to include this straight line exception for shorter-term leases.
Okay. Well, stay tuned there as well, right? Well,
absolutely.
And I think these FASB lease accounting changes could make a bigger difference in the market than people think. I think especially with the single-tenant net lease market, where a lot of those tenants may decide to own their properties rather than lease, and it could have effect on the valuations of those properties. So we'll put a link on the show webpage about the latest on FASB and how that could, what those changes, how they could affect you. And speaking of that, what do you think about these tax changes, Tom? How do you think some of this could affect the commercial real estate industry?
Well, but before the capital gains rates came down, there was a lot of activity in tax-deferred exchanges under 1031, Code Section 1031. And I think that you're going to see more activity there because of the increase in tax rates. When you think about unrecaptured 1250 gain on property that you've depreciated over many years, and you're going to reposition your real estate investment, if you have 28.8% federal tax, plus a state tax that gets up to 35%, a third of your gain is going to go away in taxes. You may want to think and think real hard about doing a deferred exchange where all of that gain will be deferred into the future. And we have clients that have been doing this successfully for many years, and because of the warping of the rules between the wealth transfer rules, estate and gift, and with the income tax rules, to the extent that you defer that gain until you die, then under the current income tax regime, that gain goes away forever. That's
great. I think there will be a lot more 1031s. And Tom, thanks for joining us today. We appreciate your insight.
Thanks so much for having me.
Now more than ever, good tax planning is crucial. If you'd like more information, visit the good friends at CohnReznick. That's Cohn, C-O-H-N, Reznick, R-E-Z-N-I-C-K. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is made available by professionals at CohnReznick, BB&T, France Media, and Bull Realty. For more information about these companies or to access additional show podcasts or videos, visit commercialrealestateshow.com.